Hello, I'm Terry Daniels, Director of Trust Investments with the Wealth Management Group at CNB Bank & Trust with your 2017 year-end market update. Before we get started, I want to let you know about 4 upcoming seminars on farm succession planning that CNB is hosting February 12th and 13th free of charge. The seminars will be led by Ron Hansen, PhD, from the University of Nebraska. On February 12th, there'll be a breakfast seminar in Taylorville at the CNB branch and a dinner seminar in Carlinville at the Elks Club. On February 13th, there will be a breakfast seminar in Pittsfield at the Dome and a dinner seminar in Jerseyville at DJ's Pub and Grill. The breakfast seminars will be held from 8:30 to 11:45 a.m. and the dinner seminars will be held from 5 to 8:15 p.m. Seating is limited, and we encourage you and your family to sign up quickly. The event will feature great giveaway items and 2 drawings at each seminar, an aerial photo of your family farm, and a farm sign featuring your operation's name. Well, now let's take a look at how the major indexes fared in 2017. U.S. and international markets were up double digits. Bonds were up single digits. Gold was up double digits, up 11.04%, and the U.S. dollar was down double digits, down about 10.75%. Specifically, for the year, the Dow Jones Industrial Average was up 28.11%. The S&P 500 index was up 21.83%, and the tech-heavy NASDAQ was up 28.24%. International stocks also had a strong finish to 2017, with developing markets up about 25% and emerging markets up about 34% for the year. The strong performance was welcome news for investors saving for retirement. But as we've cautioned before, these returns are not the norm. In fact, 2017 equity returns were more than twice their historical average. Look at this graph from ChartSource that gives us the average rates of return for U.S. and international stocks compared to bonds and cash for the period from 1987 to 2016. We can see that large stocks, like those in the Dow Jones Industrials, had an average return of 11.39% for the 29-year period, compared to 28.11% for 2017. That's more than twice the historical average. Now, we're not saying that stocks couldn't go higher from these levels, but a lot of things have to continue to go right for that to occur. Specifically, the global economic recovery would need to continue during 2018. Lower taxes would need to translate into improved corporate earnings, and interest rate increases by the Fed would need to be gradual. And finally, the geopolitical tensions experienced in 2017 would need to ease for investors to remain confident. So what could go wrong for stocks? Well, stocks could face a pullback from current levels should investor expectations be disappointed regarding the market environment, or we experience unanticipated market shocks. As we've noted before, stocks are priced for perfection, with the current level of the S&P 500 higher compared to the peak of the technology stock bubble in 2000 and just prior to the global financial crisis in 2008. So what should investors do now? We recommend that clients have realistic expectations regarding future returns, diversify, that is, don't have all your eggs in one basket, keep higher cash balances to cushion volatility, and stick to your investment strategy. That means conducting regular investment reviews to make sure your portfolio's asset allocation is in line with your risk tolerance and time horizon. In general, you want to reduce the level of risk in your portfolio as you get closer to retirement. This typically means that the mix of stocks will decrease while the mix of bonds and cash will increase as you near retirement. Thank you and Happy New Year. Don't forget to mark your calendars for our free farm succession planning seminars February 12th and 13th, featuring expert opinion from Dr. Ron Hansen.